Welcome back, everyone, for another deep dive. Today, we're going to be taking a look at some of the latest trends in U.S. household debt and credit.
All right.
And we're getting this hot off the presses from the Federal Reserve Bank of New York's fourth quarter 2024 report.
Okay, great.
They even gave us a little bonus blog post that zeroes in on auto loans.
Yeah, love those.
But, before we get into the numbers, why should any of this even matter to the listener?
I think it's a fantastic question. And, whether or not you're currently managing debt or you're feeling pretty financially secure right now, these trends are really valuable insights into consumer behavior, potential risks, and, just the overall economic landscape.
Kind of like a checkup on the economy's financial health.
Yeah, exactly.
Okay, so let's kick things off with the big picture here.
Yep.
The report shows that total household debt climbed to $18.04 trillion in Q4 of 2024.
Wow.
That's a 0.5% increase, which adds a cool $93 billion to the pile. We've been seeing this pretty steady upward trend for a while now. But is this particular increase something to be concerned about?
Yeah, I think that's a really interesting point. On the one hand, this 0.5% increase is actually a little bit slower than the previous quarters.
Okay.
But over the past year, household debt has grown by a more substantial $533 billion.
So it's slowing down, but it's still going up.
Exactly. So while things may be slowing down a bit, the overall trend is still upward.
Yeah.
So the real question is, what is actually fueling this growth?
Right, and I think that's what we're going to figure out today. So
Yeah.
let's start to break it down by the different types of debt.
Right.
First up, mortgages.
Okay.
Now, they only saw a tiny increase of $11 billion, which seems surprising to me because usually mortgages make up the bulk of household debt.
Right.
So what's going on there?
Yeah. This is where things start to get interesting. So a few things are likely at play here. First, rising interest rates over the past year might have cooled down the housing market a little bit, which leads to fewer people taking out new mortgages.
Makes sense. Fewer home buyers, fewer mortgages.
Exactly. And on the other hand, HELOC balances, those home equity lines of credit, have actually been on an upward trajectory for 11 quarters straight.
Wow.
Almost 3 years of just consistent growth.
So what does that tell us?
Well, a couple of things.
Okay.
It could indicate that people are tapping into their home equity for a lot of different reasons. Maybe it's for home renovations, maybe it's debt consolidations, or maybe even just to cover rising costs in other areas.
Okay, so speaking of covering rising costs, let's talk about credit cards.
Okay, yeah.
Balances jumped by a whopping $45 billion.
That's a big jump.
That's a huge leap.
Yeah.
Could this be a sign that people are relying more on credit cards to cope with inflation?
Yeah, it's a strong possibility. So imagine you're at the grocery store.
Yeah.
Prices of everything has gone up.
Right.
Your paycheck isn't stretching as far as it used to, but you still got to buy those essentials, right?
You got to eat.
You got to eat. Yeah, so what do? For a lot of people, the answer is they reach for that credit card.
Right.
So this increase in credit card balances could be like a little red flag that consumers are really starting to feel the pinch of inflation.
Okay, so we've got mortgages up slightly, HELOCs climbing steadily, and credit card balances taking a big jump.
Right.
What about auto loans?
Yeah, so auto loan balances, they increased by $11 billion, which reached a total of $1.66 trillion.
Okay.
While it's not, the most dramatic increase, the report actually flags this as an area to watch.
Interesting.
And remember that blog post we mentioned?
Yeah.
That takes a deep dive into the auto loan situation, and I think we should definitely explore that a little bit later.
All right, so we'll save that for later. But we've covered mortgages, HELOCs, credit cards, and auto loans. What about student loans and that other category?
Yeah, so student loan balances, they inched up by $9 billion, hitting $1.62 trillion. The pace of growth here is slower than in the past couple of years, which could be due to, a lot of different student loan forgiveness programs and payment pauses.
Right.
As for the other category, which includes things like retail cards and other types of consumer loans, we only saw a minor increase of like $8 billion.
All right, so we've kind of laid out the landscape of debt balances, but now let's talk about delinquencies.
Okay, yeah.
This is where things start to get really intriguing, for me at least, because it's not just about the overall numbers.
Right.
It's about understanding the dynamics of debt repayment.
Absolutely. And to really get the full picture, we need to go beyond just looking at the overall delinquency rates. We got to delve into something called delinquency transition rates.
Okay, so break that down for me. What are delinquency transition rates?
Yeah, so imagine 100 people are current on their auto loans, right? The delinquency transition rate tells us how many of those 100 people might slip into being 30 days late, 90 days late, and so on and so forth.
So it's like a flow, not
Yeah.
just like a snapshot.
Exactly. It's not just a static snapshot. It's actually a look at the flow of how people are managing their debt.
Right. And so the report mentions that overall delinquency rates rose slightly to 3.6%. But I have a feeling there's more to the story here.
You're reading my mind. So while the overall rate might seem relatively stable, when we actually zoom in on transitions into what we call serious delinquency, that's 90 days or more past due, we see some concerning trends emerge.
Okay.
So these rates, they actually climbed for auto loans, credit cards, and HELOCs.
So even though overall delinquencies are only up slightly, more people are falling into that serious delinquency category.
Exactly.
Wow, that is concerning. What could be driving those increases, particularly for auto loans, credit cards, and HELOCs?
Well, it's likely a combination of factors at play here. So imagine like this perfect storm brewing, right? Persistent inflation is eroding people's budgets. Higher interest rates are making debt a lot more expensive to manage. And perhaps some, job market instability is adding fuel to the fire.
Right, so it's like a recipe for financial stress.
Unfortunately, yeah, it is.
Especially with the report highlighting that auto loan situation as a particular area of concern. And we've got that blog post to unpack later, which, goes into that.
Exactly.
But before we do that, let's connect all of this back to you, the listener.
Yes.
Even if you're not personally grappling with rising debt or delinquency, these trends offer valuable insights into the economy's pulse and potential future risks.
And they also underscore the importance of, just thoughtful financial decision making.
Yeah.
Especially when it comes to taking on new debt. Understanding these trends can really help you make informed choices that align with your own financial goals and your own risk tolerance.
Okay, we're going to pause here for a moment, but when we come back, we'll dissect that blog post on auto loans and we'll discuss, some of the potential implications of these trends. So stay with us. All right, so let's dig into that blog post on auto loan delinquencies.
Okay.
It's called Delinquency Rates in the Auto Loan Market Remain Elevated. And honestly, it was a little bit of an eye-opener for me.
It really does paint a stark picture. And I think the most striking takeaway here is that you're seeing these high auto loan delinquency rates hit borrowers across all credit scores, not just those with lower scores.
So even people with good credit are struggling to keep up with their car payments.
Yeah.
Okay, that's a little unsettling. What could be driving that trend?
Well, it really suggests that, the factors driving these delinquencies are much more widespread, and they're likely tied to those broader economic pressures we talked about earlier.
Right, like even if people with excellent credit are struggling,
Right.
it's got to be something bigger going on.
Yeah, exactly.
Yeah, the blog post breaks it down by credit score and by income level, and it is pretty startling.
Yeah.
Borrowers with credit scores below 660 had delinquency rates over 10%.
Wow.
But even those with scores above 760, which is considered excellent credit, were facing delinquency rates over 2%,
Right.
which is still significant.
It is, especially for those who might just assume that, their good credit is going to shield them from these types of issues.
Right.
It's a really crucial point. And, the data on income levels, it paints a pretty similar picture. Delinquency rates were elevated across all income brackets.
Right.
Those in the lowest income group, they saw rates over 14%, while those in the highest income group still faced rates above 2%.
Yeah.
So, this data really reinforces the idea that those auto loan delinquencies are kind of a symptom of a larger problem affecting, a broad spectrum of people.
So what are the main culprits here? What's really pushing people to the brink, regardless of credit score or income?
Well, inflation, even though it's cooled down some, it's still definitely a factor. Prices for essential goods and services are still really high, and it's just squeezing household budgets.
Right.
Imagine, trying to fill your gas tank in your grocery cart. When those costs just keep climbing, it really eats into your ability to keep up with other expenses like your car payment.
Right. And we can't forget about rising interest rates.
Yeah, absolutely.
They've got to be like a double whammy for consumers.
Yeah, the Federal Reserve raising interest rates to combat inflation makes borrowing more expensive.
Right.
So you have cars themselves costing more because of inflation.
Right.
And then on top of that, the loans to actually buy them are pricier too.
Ooh.
It's a really tough spot to be in.
Then you add in some volatility in the job market,
Right.
like layoffs and hiring freezes in certain sectors.
Yeah.
And it becomes even harder, I think, for folks to keep up with their financial obligations, car payments included.
It is. It's a perfect storm.
Yeah, so the blog post suggests that these factors are likely to continue to pressure those auto loan delinquency rates for the foreseeable future.
Yeah. And that's That's not exactly encouraging news, but,
Yeah.
it's definitely better to be aware of these risks than to just be blindsided by them.
So what can we do? What can we do as consumers to protect ourselves in this environment?
Well, if you're thinking about taking out an auto loan, I would say, meticulously review your budget. Just ensure you can comfortably afford those monthly payments, especially, if interest rates continue to climb.
Makes sense. And what if someone is already like struggling to make their car payments? What options are available to them?
Well, I would say the first thing is to reach out to your lender as soon as possible. They might be able to modify your loan terms or just explore other options to help you avoid delinquency.
Right.
The key is communication. Let them know you're facing challenges and see what solutions you can work out together.
It's not one of those situations where you just bury your head in the sand,
Exactly.
right? You got to be proactive.
You got to be proactive. And I think, you know, looking beyond just those individual actions, policymakers also really need to consider the ripple effects of their decisions on consumers, particularly when it comes to managing, interest rates and inflation.
Right.
It's a really delicate balancing act, but the choices that they make have really real-world consequences for people's financial well-being.
So it makes me wonder about like the potential long-term implications here. What happens if household debt just continues to rise at this rate and delinquency rates keep climbing?
Yeah, it's a valid concern if these pressures keep mounting.
Yeah.
It could eventually pose some risks to the stability of like the entire financial system.
Oh, wow.
Think of it like a domino effect, right? More people defaulting on loans could lead to losses for lenders,
Yeah.
which then ripples through the economy and impacts everybody.
And it's not just the financial institutions that are going to suffer.
Right.
High levels of household debt, I can weigh on economic growth as a whole.
Absolutely.
So consumers burdened by debt have less disposable income to spend,
Exactly.
which can slow down the economy. It's just a vicious cycle.
It is a vicious cycle. And that's why it's just so important to really monitor these trends, understand their potential consequences, and address those underlying issues that are actually contributing to them.
Right.
It's not just about numbers on a report. It's about people's lives and their livelihoods.
So I'm hearing like a lot of doom and gloom. Is there anything positive that we can take away from this report and this blog post?
Yeah, the good news is that delinquency transition rates for mortgages have actually remained stable.
Yeah.
Though this suggests that, the housing market, at least for now, is weathering the storm reasonably well. So it's a little glimmer of hope amidst all of this uncertainty.
Yeah, it's a very welcome bit of good news.
Yeah.
It's also a reminder, I think, that these trends are really dynamic and they can shift over time.
It's absolutely.
The economy is constantly evolving.
It is. And that's why it's just so crucial to stay informed and, be able to adapt to that changing landscape. The more you understand about what's happening, the better prepared you'll be to kind of navigate the ups and downs.
Well said. Okay, so listener, we've taken a really deep dive today into the world of household debt and credit.
Yeah.
We've explored the overall trends, the specific challenges facing the auto loan market, and the potential implications of these trends for the economy and individuals like you.
And we haven't just, presented the data. We've actually encouraged you to really think critically about what it all means.
Right.
Like what factors are driving these changes? What other economic indicators should you be paying attention to? These are really important questions to consider.
Yeah, because at the end of the day, knowledge is power.
Exactly.
And understanding these trends empowers you to take control of your own financial well-being.
Absolutely.
But I think we've only scratched the surface here. So now it's your turn to, delve deeper, do your own research, and draw your own conclusions.
Yeah. And remember, even though, the data can sometimes feel really overwhelming, it's important to remember that behind these numbers are real people making real decisions.
Right.
We're all in this together.
Absolutely. Well, thanks for joining us on this deep dive. We'll see you next time. It's easy to get kind of caught up in all the doom and gloom when we're talking about, rising debt and delinquencies and all that.
For sure.
But I think it's super important to remember that every data point represents a real person who's grappling with real-life financial decisions.
Absolutely. These aren't just abstract numbers on a spreadsheet. They're reflecting the experiences of, millions of Americans trying to navigate this complex economic landscape.
And, those experiences are anything but uniform.
Right.
Like, for some people, rising debt might be like a flashing red light.
Yeah.
A sign of, like, real financial strain.
Right. A sign that they're struggling to manage.
But for others, it could represent a calculated risk.
Yeah.
a step towards a long-term goal, like
Yeah.
investing in a home or starting a business.
Exactly.
Like, debt isn't inherently good or bad.
Right.
It's a tool.
It's a tool, yeah.
And like any tool, it can be used effectively or ineffectively.
Yeah, I think that's a great point.
So context is everything.
Right.
And understanding, the broader economic forces can help us make smarter decisions about how we use that tool.
Exactly. For
Yeah.
example, if you're aware that, interest rates are on the rise, you might be a little more hesitant to take on new debt,
Hmm.
or maybe you prioritize paying down existing debt to reduce your overall financial burden.
Makes sense. So it's about being proactive.
It is. It's about being proactive and strategic.
It all kind of boils down to awareness and having a plan.
Yeah.
Like whether you're saving for a down payment or tackling student loans or even just trying to manage your day-to-day expenses, a clear financial plan can help
It
you.
could be like your compass,
Yeah.
guiding you through those economic storms.
And that brings us back to, I think, the importance of financial literacy.
Yeah.
Like the more we understand how the economy works and how our personal finances fit into that bigger picture,
Right.
the better we'll be at making those sound decisions.
Yeah, financial literacy is essential for everybody regardless of your income level or your background.
Right.
It's about empowering yourself to really take control of your own financial well-being.
So to kind of wrap things up today,
Yeah.
we've explored those latest trends in U.S. household debt and credit.
We have.
We've uncovered some potential risks and challenges,
Right.
but I think we've also emphasized the power of individual awareness, strategic decision-making, and of course, financial literacy.
And we've encouraged you to look beyond those headlines,
Yeah.
to dig a little deeper, to connect the dots between these trends and other economic indicators, and to just form your own conclusions, because ultimately knowledge is power.
And hopefully this deep dive has empowered you to navigate these, complex financial waters with a little bit more confidence and a little bit more clarity.
Absolutely. Thanks for joining us. Until next time.
Yeah.
Keep learning, keep asking questions, and keep striving for financial